Welcome back to Money Matters. I'm DCrowell from Mortgage Network, and I'm following up from the first half of the show in which I talked about healthcare in grand general terms, the basic two problems that confront us as a nation and as an economy as we attempt to deal with healthcare. Now, tagging on to where I left off, and I'm going to evolve here. As I go across this piece of landscape, I'm going to evolve all the way to interest rates. The healthcare debate breaks down pretty quickly if you come up with a solution to problem number two, which was the cost or consumption of medical services per capita. If you come up with a solution to that problem and make the system turn on its head and everyone in it benefits by, directly, personally benefits by consumption of less health care, then a smaller amount of the GDP gets consumed on health care. If a smaller amount of the GDP gets consumed on health care, then a larger amount of the GDP is available for everything else, for all other aspects that affect the quality of life. So if you pay less for health care, you pay more, you have more money available to do other good things with. Education, housing, all of the other things that we consider to be key. Now, how do we get there? And what are the steps? Well, the first is the free market is probably, this is the big debate between liberals and conservatives. The free market is appearing less and less likely to get there on its own. Major players in the healthcare market, major corporations, are corporations. They must be free to seek profit where they can find it. They cannot be expected, nor is it fair to expect them, to do things out of motivations of public service, out of good-heartedness, out of the greatest good for the greatest number of people. None of those other ancillary or secondary objectives and benefits can they be expected to do. The big corporations are in business to make money, the big healthcare corporations, and that's what they do. Aetna has just pulled out of, Aetna is one of the largest insurance providers in the country, has just pulled out of many, and I'm fuzzy on this exact point, but many, if not all, of the ACA markets, of the Obamacare markets. That's Aetna's right to do. On the other hand, Aetna has really one major customer, and that's the government. So if Aetna in 2016 made $100 billion or had $100 billion of receipts from healthcare, and I'm just picking a number here, 90 billion of those dollars came from, not directly from DCrowell or directly from Susan Smith or directly from some other person. 90 billion of the 100 billion came in a check from the government. So there is a rub here. There's a little bit of having it both ways. Aetna's pulled out of the markets, having happily accepted the $90 billion check from its largest customer for many years, and now, because of a squeeze on profits or a difficulty in pricing the markets because of the chaos in the health market, it has pulled out. There's another major health company, United Healthcare, which has just been sued by the government for overbilling Medicare and Medicaid as a systematic process. They have a big team of people that goes back into clients, into elderly people's charts, and prescribes and bills for extra goods and extra services because they can. So it's a systematic abuse of the health system, and Medicare and Medicaid are both being or have been in the last period of time overbilled by literally tens of billions of dollars by United Healthcare. So there's you know, it's tough. The major corporation has to come in and do what's best for the bottom line, but at the same time, national health policy has to dictate outcomes. So how do you do it? Interest rates, what's the impact on the economy as a whole and on interest rates? The non-contributory expense in the society, those dollars which are spent which do not contribute to the greater productivity of the human beings in the society or the greater productivity of its institutions, leads to a society which is less efficient, an economy which is less efficient and less productive. And less efficient, less productive means that over time there is a marginal cost which has to be picked up somewhere. Eventually, in our society, it gets picked up by the federal government in the form of a deficit. In other societies that don't run deficits, it gets picked up by the individual members of the society and takes the form of lower standards of living. So the inefficiency in a closed economy, the inefficiency needs to be, it's like a bill that needs to be paid, and it gets picked up one place or another. The way we've solved it for the last 10 years, 9 years, is we've made money extraordinarily inexpensive to borrow, and the biggest borrower is the government, and the second biggest borrowers, of course, all of the major corporations. So the bond market has been extraordinarily strong for a 10-year period, forcing yields and interest rates down. When you have a vast pool of extraordinarily cheap money, the easiest way to cover or mask these inefficiencies in the economic system as a whole, the easiest way to cover for that, the easiest way to get by to the next day, remember I said it's got to be paid for somehow, is to take the loss and have it not hurt too much. How does it not hurt too much? Because you can borrow money at an extraordinarily cheap price. So corporations are able to borrow very, very inexpensively. The US government's able to borrow incredibly inexpensively. Other inefficient institutions, for example, for-pay colleges, and indeed the entire state-run university system, which is run very inefficiently. In other words, how many people pay and incur massive numbers of student loans who don't graduate, and so forth and so on. Any place that you find gross inefficiency, what you also find usually, this is not 100% of the time, but usually, you find very nearby a source of very cheap financing, because an inefficient activity cannot persist over time. There's enormous inertia, very little momentum to an inefficient system. An inefficient system eventually and quite quickly grinds to a halt unless there's some outside force that allows it to keep going. In this case, the outside force that allows it to keep going is interest rates. As long as the money's cheap, as long as there's a source of money that allows healthcare to be provided cheap, supported by cheap money, that allows an imperfect education system to be supported by outside cheap money, then the inefficiencies will persist. As soon as we have a tightening of the very cheap money, which is forecast to take place sometime gradually over the next couple of years, the pressure on these institutions to tighten up will become enormous because people won't be able to afford the money to buy the inefficiently provided product. Okay, that's it. And this is David Crowell signing off for Money Matters. I hope you've enjoyed the show. This is Friday the 26th, and we're headed into Memorial Day weekend. I hope you all have a great time, and I'm sure you'll be thinking about what I had to say all weekend long. Bye-bye.